Welcome to Iron Financial. Here, our mission is simple, to forge stronger portfolios and to cut right through the market weakness by putting companies through the ultimate stress test. Today, we are putting BRP, ticker symbol DOO, on the anvil. They just dropped a Q4 earnings report that honestly looks like an absolute monster on the surface. We're talking numbers that could make any investor's heart race. But here, you know we don't just look at the shiny paint job. We look for cracks in the foundation. You know the names, right? Sea-Doo, Ski-Doo, Can-Am. They build the machines for the weekend warriors, these high-octane toys that just dominate the trails and the water. The products are incredibly popular. There is absolutely no question about that. But popularity, well, it doesn't pay the bills if the balance sheet is just a house of cards. The real question for us as investors is whether the company behind all these thrilling products has a rock-solid financial structure or if it's just one bad economic turn away from a total wipeout. We're here to see if this is a serious investment or if it's just a fun joyride that's going to end badly. So let's just frame the whole debate right here. BRP's Q4 numbers, they look spectacular. I mean, they're posting massive growth that would make most other companies just green with envy. But at Iron Financial, we know that headline numbers can hide some really serious underlying weakness. We always look deeper. So we're asking the big question today. Is this engine really roaring with sustainable long-term power? Or is the financial chassis that's holding it all together about to crack under all that strain?
And to answer that, we're running BRP through our classic 5-point stress test. First up, we'll look at why that engine appears to be roaring, breaking down those really powerful Q4 results. Second, we're going to pop the hood and inspect the product mix, the powertrain that's driving all these numbers. Third, and listen, this is absolutely crucial, we are checking the chassis for any stress fractures, any cracks at all. Fourth, we'll look down the road, ahead. What's management guiding for, and how is this stock valued? And then finally, we'll deliver Iron Financial's official verdict. Okay, let's get into it.
All right, let's start with the bull case. And frankly, it's a powerful one. I mean, it's compelling. We're going to walk through the top-line numbers from their fourth quarter report, and you are going to see exactly why the market got so excited. These figures, they really represent the raw power of the company's recent performance.
First up, revenue. A 16% year-over-year increase in the fourth quarter. Now think about that. In this economy, with all this constant chatter about consumer slowdowns and discretionary spending just drying up, posting double-digit top-line growth, that is a massive statement of strength. They're not just selling products, they're selling more of them, probably at higher prices, and they're moving a really favorable products mix. This right here is the first sign of a very high-performance engine.
But this is where it gets even more impressive. Just look at the profitability. Normalized EBITDA surged by over 47%. You know what that shows you? Incredible operational leverage. It means that for every new dollar of revenue that comes in the door, a much larger chunk of it is dropping straight down to the bottom line as pure profit. So they aren't just growing, they're growing more efficiently and way more profitably. That's a sign of a well-tuned machine firing on all cylinders.
And this is the knockout punch. Net income growth of nearly 191%. Let that sink in. You just don't see numbers like this from a multi-billion-dollar company. This isn't some speculative startup we're talking about. This is an established industrial player posting explosive, almost venture capital level growth on its bottom line. On the surface, I mean, this is just an overwhelming display of financial horsepower that you simply cannot ignore.
Now, I know what you're thinking. The skeptic in you might be asking, are they just stuffing the channel? Are they just shipping to dealers who can't move the product? Well, this slide answers that question with a very definitive no. These are retail sales. These are actual customers walking into dealerships and buying Can-Ams and Ski-Boos at a 12% higher clip than they did last year. This connects all those stellar financial reports directly to real-world, boots-on-the-ground demand. The product is absolutely flying off the shelves.
Okay, those are some heavy-hitting numbers for sure, and the CEO is obviously feeling pretty good about it. But a powerful engine is absolutely nothing if the frame it's bolted to is weak. Conviction is great, but cash and fundamentals, well, they're better. What is actually driving this growth? Is this just a temporary sugar high from some new models, or is there something more fundamental, something more durable, happening under the surface? We've got to look closer.
Exactly. Headline numbers, they're just the dashboard. Now it's time to pop the hood. Let's really see which parts of this business are doing the heavy lifting by breaking down that revenue mix.
So here's the core of the business. Over half of their revenue, 54%, comes from what they call year-round products. Think of their Can-Am off-road vehicles, the side-by-sides and the ATVs. This right here is the bedrock of the entire company. Then you've got 32% from seasonal products like the Sea-Doo personal watercraft and the Ski-Doo snowmobiles. The last 14% is parts, accessories, and apparel, the high-margin stuff. So the key takeaway here is, while we all know them for that seasonal fun, their biggest business is actually the all-year-round off-road segment, and that provides a much more stable foundation.
And this just brilliantly illustrates the health of the business. Just look at this growth. It's not one segment carrying the whole company on its back. Year-round products are up almost 17%, and that's driven by new off-road vehicle models. And seasonal products are up a massive 17.5%, which is driven by big rebound in personal watercraft shipments. Even the higher-margin parts and accessories business is growing at nearly 10%. This is what we love to see: balanced, robust strength across the entire product portfolio.
Okay, now, this slide right here. This might be the single most important piece of evidence for the bulls, so pay close attention. Look at this comparison. While the overall industry for year-round products was flat, zero growth, BRP grew retail sales in the high single digits. And for seasonal products, the industry grew in the high single digits, but BRP, they grew in the mid-teens. This is not a company that's just riding a market tailwind. This is a company that is actively and aggressively taking market share from its competitors. They are out-executing, they are out-innovating, and they are winning. This is what dominance looks like. But, as impressive as all this is, the skeptic in me says we have to pressure test this whole structure.
All right, fine. The engine is powerful. They're taking market share. I get it. I see it. But a powerful engine is completely useless if the frame it's bolted to is weak and riddled with rust. All that torque is just going to tear it apart. So it's time to stop admiring the horsepower and start pressure testing the chassis. It's time to go searching for those financial stress fractures that could cause this whole thing to collapse when you least expect it.
Now, before we go full-on bear, let's just acknowledge one more pillar of strength here. We're talking nearly $900 million in free cash flow for the full year. That is not accounting magic. That is cold, hard cash generated from the business after all the expenses and investments are paid for. You can't fake that, and that's a thick piece of steel in the financial framework we're about to inspect.
That's a solid number, I will give you that. But a lot of that cash came from favorable changes in working capital, not just pure operating profit. It was a bit of a tailwind, you see. And more importantly, that cash flow doesn't exist in a vacuum. What about the other side of the ledger? What about the debt that's holding this whole thing together? A truly strong company isn't just about the cash coming in the door, it's about the liabilities that could bring it all crashing down in a storm.
And here it is, the first major crack in the armor, a debt-to-equity ratio of 4.9. Let's be absolutely crystal clear about what this number means. For every single dollar of equity in this company, there are nearly $5 of debt piled on top of it. This is a highly leveraged structure. It means the company is using a massive amount of borrowed money to finance its operations and its growth. Now, this amplifies returns on the way up, sure, but it can be absolutely brutal and unforgiving on the way down. This is a significant leverage risk, especially in a volatile economy like this one.
And hey, it's not just me saying it. Look at the Altman Z-score. It's a proven formula for predicting bankruptcy. A score of 2.28 puts BRP squarely in the gray zone. Now, for context, scores above 3 are considered safe and below 1.8 are in the distress zone. BRP is uncomfortably stuck right in the middle. This tells us that while the company isn't on the verge of immediate collapse, it is absolutely carrying a measurable level of financial stress. It does not have the solid ironclad foundation of a truly safe investment. And here's the final red flag for me. This one's a management issue. They had to take a nearly $250 million impairment charge, a write-down, on their electric vehicle and light mobility assets. This is a massive strategic failure. They poured capital into a new venture, and it failed so spectacularly they had to basically admit those assets are worthless. This raises some very serious questions about management's ability to allocate capital effectively into new ventures. This isn't a small mistake, folks. It's a huge financial pothole.
Those are all valid points. I get it. The debt is a concern, and that EV write-down is a really bad luck. But you're focusing on the bumps in the road that are behind us. The market is a forward-looking machine. So let's turn our attention to the road ahead. Because, frankly, the company's own guidance and its current valuation, well, they tell a very, very different story about what's coming next.
So let's just tackle this valuation debate head-on. The bears out there, they're going to point to the trailing PE ratio, which is over 200. I mean, it looks insane. But that number is distorted by past events, like that big EV write-down we just talked about. That crushed their reported earnings and makes the stock look absurdly overvalued. But that's looking in the rearview mirror. The bulls, they're looking forward, and the forward PE, which is based on what analysts expect for next year's earnings, is a much more reasonable 15.7. This suggests that the expected earnings growth actually makes today's price look kind of cheap.
And this right here, is the foundation for that reasonable forward PE. This is management's own guidance for fiscal year 2027. They're projecting continued growth across every single key metric. Revenues climbing towards over $9 billion. Normalized EBITDA pushing past $1.2 billion. And normalized EPS growing right along with it. Management is publicly committing to building on this year's strength, not retreating from it. This is a confident forecast for the road ahead.
And it's not just talk. This is the important part. Management is putting its money where its mouth is. They just increased the quarterly dividend, which sends more cold, hard cash directly back to shareholders. And they spent over $50 million in the last quarter alone buying back their own stock. You know, these are not the actions of a management team that's worried about the chassis cracking. These are capital return policies that signal a deep and abiding confidence in the company's future performance and cash flow.
So we've seen both sides of the coin. The bull case is its high-torque engine of growth, these huge market share gains, and a really confident outlook. The bear case, on the other hand, points to a high-leverage chassis, some questionable capital allocation, and clear financial stress signals. So, it's time. It's time to weigh the evidence and deliver the verdict. Is BRP an opportunity to build a stronger portfolio, or is it a high-speed trap waiting to spring?
Let's just summarize the battle right here. The bulls. They have everything you could possibly want to see in a growth story. Record numbers across the board, clear evidence they're stealing business from their competitors, a strong guide for the next year, and they're returning cash to shareholders. Can't argue with that. But the bears, they have everything that should keep an investor up at night. A mountain of debt that makes the company fragile, a quantitative score that is literally flagging financial stress, a massive strategic blunder in the EV space, and a valuation that just looks insane if you're only looking backward.
So here it is, Iron Financial's final verdict. BRP is a high-performance machine with a supercharged engine. The growth is absolutely real, the market share gains are undeniable, and the products are clear winners in the marketplace. But, and this is a very big but, it's all bolted to a high-leverage chassis. The debt is not trivial. The financial structure carries significant risk. This means if you're going to own this stock, you would better be an investor who can handle the bumps in the road, because that high debt load means any economic downturn or any operational misstep will be felt much, much more severely.
So we leave you with the final question. With its engine absolutely roaring, but its financial frame clearly under a lot of stress, is BRP a risk you are willing to take? Is the potential reward from this high-growth engine worth the very real risk of its highly leveraged chassis? That is the question you have to answer when deciding if this company can help you forge a stronger portfolio. That's all for this stress test from Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.